It is a great pleasure to be joined by Robert Lloyd George, who is the Chief Investment Officer at Lloyd George Advisory in Hong Kong. How are you, Robert?
John, it's always a pleasure to talk to you, and I greatly appreciate having some Canadian listeners, and I hope we can enlighten them on what's happening in Asia.
Well, you've been wandering the world, and I have just reread your April 2016 Outlook entitled The Deleveraging of China. And I guess where I'd like to start is getting your take on the first 4 months and almost 5 months of 2016.
Well, as you know, John, we started the year with a very weak global market, and I think that was even more exaggerated in Asia with the Japan, Hong Kong, China, nearly all the Asian markets falling between 10 and 15% by the middle of February. Now, I'm not quite sure what changed the mood in mid-February. It may have been some reflationary announcement that we had in Tokyo, but I think that what is certain is that China, the government in China, decided that they could not risk a significant slowdown. And I think this is a very interesting lesson for us as investors. We always look at the economics, but actually it's the politics that finally swings things. And they couldn't face the possibility of higher unemployment and a growth rate which some observers say is now down to 4 or 5%. They're publishing it 6-7%, but who knows? So they injected about $1 trillion into what is now a $10 trillion economy of what they call total social financing, or money printing or lending by the banking system. And some of that evidently went into property. We saw Shanghai and Shenzhen, the adjacent city to Hong Kong, property prices rising very sharply. But most of all, I think the industrial commodities, it's now possible for Chinese retail investors to speculate in iron ore, in gold, in oil, in many different commodities which were really not available before. So we had a very surprising jump of 40% in iron ore, copper, I think 25%, and oil, of course, whether that was only the Chinese or whether it was the Middle East as well, it's hard to say, but it jumped from $26 to now $48. So we've had almost 100%, about 85% jump in the oil price. And I think that's been very important for sentiment. And, of course, markets by the end of March had rebounded to where they started the year, and we're probably now in positive territory. But I think the question is, how long can this stimulation last? And I don't think that in the case of China that it is going into real productive investment. Their infrastructure spending has reached a kind of max, really. I mean, they can't build more bridges and roads or railways at a certain point. Japan had the same experience 20 years ago. They've spent a large amount of capital on infrastructure, which is great, but they've maxed out, I think, now.
And we're seeing slowing world trade and manufacturing, and the ill winds of protectionism are blowing.
Correct. And I think that is very worrying, John, because not only the rhetoric of Mr. Trump in the United States, but also our Brexiteers in the UK who would like to take us out of the European Union and that free trade area. And I think for the Asian exporters, there is a very worrying trend that I think every election China gets blamed, but it seems to be across the board, Democrats and Republicans this year, that there is a sense that China's taken advantage of the average American by their low labor costs and that they should be punished or prevented. And so I think there is a sense that this long period of 25 years of free trade, globalization, lower tariffs, World Trade Organization access for China, and therefore their ability to sell into nearly everywhere is coming to an end. It will be harder in the next 5 to 10 years.
And the U.S. needs a weaker dollar on one hand, but the Fed seems to be speaking out of both sides of their mouth because we, every second week, seem to hear about the prospect from half the Fed governors of higher interest rates.
Correct. And the most surprising thing is that the Japanese, who are pushing harder than anybody else to get their currency down, and by pushing negative interest rates to, I think, almost minus 1%, the yen has jumped. And this was really a contrarian development, and I think that it's causing some problems in Japan.
Well, let's talk about China's bad debt problems and the impact on Hong Kong and the ripple effect.
Well, I don't want to sound too bearish because I think that we've seen this movie before, and although it's on a larger scale, the bad debts may be up to $1.5 trillion or 15% of GDP. But, the Chinese government controls every bank in China. There's a Communist Party official running every major financial institution, and they will be able to reschedule these loans, repackage them, sell them off, put them into asset management companies, which is what they did 10 years ago when they listed all the major banks in China. And I'm sure they will find some way to kick the can down the road, as we say, or smooth over the problem. But I think it is a bigger problem, and I think it's affecting growth. This is my bottom line feeling that, China will be growing 3 or 4%. And that's not a disaster, but it's a different global scenario to what we've seen in the last 10 years. So, we've already seen the impact on commodities, but there is going to be an impact on their trading partners. There's going to be an impact on property prices around the world and on capital flows out of China. And I think that it is not yet visible how this Chinese slowdown is going to affect. Clearly, Hong Kong is the most immediately affected because it depends on Chinese capital inflows and Chinese tourists. And we're seeing retail sales and rents falling steadily in Hong Kong. So I think there is a kind of deflationary effect in the immediate vicinity of China. And for the time being, Chinese tourists are still traveling, and we're seeing that positive impact in Korea and Japan. And I would hope that that will be maintained, that the consumer side of the Chinese economy will hold up. But clearly, the industrial side and everything to do with lending, the banking, property, infrastructure is slowing down sharply.
Now, India is your favored port in an economic storm, and I guess I'd, ancillary to that, ask you about other frontier markets that you like.
Well, I think Mr. Modi doesn't always get a good press, but we're hearing on the ground from our people in Bombay that he is steadily progressing in his fight against corruption and bureaucracy and cleaning up the corporate sector in India. So we really feel from an investor point of view, this is very important, that we are getting good growth in India, 7 to 8%, earnings growth up to 20%, clearer balance sheets and corporate governance. Even the banks are looking better. And most of all, India is 25 years behind China in terms of infrastructure development. Over half the population of India still doesn't have access to electricity. And this is a tremendously important development that Modi, who did a very good job in his home state of Gujarat, is now extending that to the whole of India and building out transmission lines. So we, for example, we're looking at the power grid company, which is a nationalized power company, and the coal industry in India, because we see that need for electricity is tremendously important. And around India, we're looking at Pakistan, Bangladesh, Sri Lanka, and some of the smaller markets like Mauritius and Myanmar, because we see the same 7 to 8% growth, stable currency and political background, and young demographics, young consumer population, and really this region not deeply affected by what happens in North America, Europe, or even in China. They're not interconnected in terms of trade and capital flows. It is a self-contained world, and a world where trade and investment and consumer spending are still growing at a good rate. And I think that's going to be the trend for the next 5 years.
Robert, I'd like to break for a moment and come back for a second segment. So stay with us, folks. You are listening to 580 CFRA. I'm back with Robert Lloyd George, who is the Chief Investment Officer of Lloyd George Advisory in Hong Kong. Robert, I was wanting to ask you about the recent election in the Philippines, and it seems that they have elected their version of Donald Trump.
That's right, John. He's called Duterte, and he was the mayor of Davao City in the southern island of Mindanao, which had been, I think, an area of high crime and Islamic activity and so on and so forth. And he's obviously a tough guy who became popular by basically taking a vigilante approach to crime and cracking down. And so he's proposed this on a national level, and I think he won a big plurality of the votes because none of his opponents were really that convincing. There is a concern that, he's not, rather like Trump, he's not politically experienced or constitutionally minded, and that he may take some fairly strong actions which would upset investors. But it's not yet clear for us whether this new president will be good for the market and the currency. I think the Philippines is one of the most interesting economies in our region, 100 million people, 10 million of whom are working overseas. The remittances from overseas Filipinos are something like 15 or 20 billion a year. It's a big number. And, they're just very hardworking, good people, but they've had this appalling political scene at home and very little employment opportunities. So there's some great companies down there, both consumer banking and some mining companies. We've invested, for example, in Universal Robina, which is a supermarket chain which is expanding into Southeast Asia. Very, very good management. Another one called Jollibee, which is the only place in the world where the local competitor has gained a majority market share compared to McDonald's in the fast food market. So that's kind of an interesting company as well. So Philippines, interesting to watch, I think.
In addition to India, which we talked about earlier, why are you focusing on Australia?
Well, actually, Australia is traditionally seen, perhaps a little bit like Canada, as a place for investing in natural resources. They have oil and gas, and they have a big mining industry, some of the biggest companies in the world. And clearly, we're interested in a couple of smaller gold mines like Newcrest and Evolution, and I think those are competitive and interesting. But the most interesting sector to me is the healthcare sector in Australia. And when I was down in Australia a couple of months ago, I visited a handful of these companies, Ramsay Healthcare, Cochlear, which is the ear implant company, and a very interesting new startup company called Nanosonics, which does the cleaning and disinfecting of hospital instrumentation after operations with a radio-intensive process. It's a wave process, and it's very, very effective. And they've developed it in the hospitals in Australia where it's been very widely recognized. They're starting to sell into North America, and it's probably a company of less than $2 billion, which we thought was very interesting.
Now, we're in a market of high-frequency trading and algorithmic programs, and these markets need a lot of liquidity. What happens if we hit a dry spell?
Well, I think we are going to have more volatility in currencies and in share markets because of this growing drought of liquidity and the tendency for these automated trading programs, high-frequency trading, to all move in the same direction. So this concerns me, John, and I'm not quite sure how it pans out, but we are very, very conscious of liquidity in our markets. We need to feel that any company that we invest in would be able to be liquidated within 3 days. That's our rule of thumb. And generally speaking, the Asian markets are well traded. We take a rifle shot approach. We just own great companies in every market. We're not buying markets or buying indices. We don't pay attention to that. We just feel we've got some really good companies, and we want to be with those companies. Whether the economic trend is up or down, they will continue to grow,
Well, you and I earlier were talking about a great book called Wealth, War, and Wisdom by Barton Biggs. And in it, he mentions that had you owned the shares of Bayer through both wars, you would be just fine. And there are a number of companies like that.
Yes.
And Royal Dutch Shell is another one that's been involved in 100 currencies for 100 years, and they have survived quite nicely.
Yes, and I think it's all down to management and reliability and sustainability. And we found a handful of those type of companies. I mean, in North America, you look at the Dividend Achievers, people who consistently increase dividends over a period of 10 years. And we found a handful of those in Japan, Hong Kong, even in China, where the history is shorter. We're beginning to see some companies that consistently reward their shareholders with dividends. And that is, I think you've referred to Royal Dutch Shell. That's a fine example of the same thing, where you have a long track record of consistency and transparency.
Now, this discussion would not be complete without your comment on the real Donald and American politics.
Well, I think that is behind the scenes every day in the markets, John, that people are concerned, they are worried, and they're puzzled. The prospect that Donald Trump could easily become president in November. What will he do? How will it affect trade and the economy? And maybe it won't be as bad as the rhetoric, but I think that and the prospect that in a month's time, probably by the time we talk again, Britain might possibly have voted to get out of the European Union will cause a lot of unforeseen consequences for investors. Those are the two biggest worries at the moment.
And to conclude, and you just mentioned Brexit, we're in the home stretch, and what's your assessment
I'm
of
firmly in the camp that from an economic point of view, Britain will be much better off staying in the European Union and trying to reform it from within, as we have done with the single market. But I have to say that I was in London 3 weeks ago with 30 of my contemporaries, city types and people in business, and I would say 80 to 90% of them were in favor of getting out. So this was quite a surprise to me, because I'm convinced when I visit London, you see that London has boomed in the last 10 to 15 years from being the financial and economic capital of Europe. There are over 1 million Europeans. They say 500,000 French people in London. There's talented people, chefs and investment bankers and people working in shops and restaurants and from all over Europe. And capital is poured into London. You can see the property prices are very high. I'm afraid all this could go into reverse, So I am really concerned that we're at a watershed with this vote on the 23rd of June.
Well, that's a great update, and thank you. It's wonderful to have you join us on a regular basis, and we'll look forward to talking to you next month for your May